PowerPoint. We'll do this with backgrounds, so you get the dulcet tones and the face to go with it. So apologies for that, but good to have you here, and thanks for turning up. Webinars are a bit of a strange one now. Everyone had time for them at the start of the pandemic. Everyone got bored of them, and then people have basically run out of time working from home and wondered how they ever managed to commute in the first place. But yeah, thanks for making the time and giving me an opportunity to wear a shirt rather than a hoodie. It's greatly appreciated. What we want to do today, and I'm really glad that I've got Ian here as well, because Ian runs AON's credit insurance business, and much like me, spends a lot of time speaking with clients around exactly what risks they're facing and how to mitigate them. So if I spend the first sort of 10 minutes or so, maybe bringing the mood down, but apologies, it's Brexit, it's not me. Ian will bring us back up again. And then after that, we'll stay around for some Q&As, but we will aim to get you out of the meeting by 11:30, so running to time. So I think just to set the tone of where we are at the moment, and aside from everyone being bored of Brexit, only 70% of large businesses say that they're ready and will be ready by the 31st of December. More worryingly, only 30% of medium-sized businesses and only 20% of small businesses think that they are ready or are going to be ready in time. And that number would have been a lot higher if you rewound the clock to February, March, but obviously COVID has taken the resources out of the room. Everyone's been dealing with something else that has been far more immediate and therefore has obviously taken priority. So if you think that you're not ready, you're certainly not alone. And a spoiler alert here, we're not going to give you all the answers today because we're still very much waiting for them to come out of the government. So apologies there, but I don't think it's fair to lead you into a false sense of security that after this you'll have all the answers. So yeah, let's start where we think a reality is, and that is delays being inevitable. Delays are going to be inevitable whether we get a deal or not, purely because of the numbers you see there. You know, if a government system is going to see a fourfold increase in traffic, I mean, chances are it's going to collapse, but sort of best case, really, it's going to be bursting at the seams. So if we set that as a known quantity and remove it as a variable, at least it gives us something to work with. And the sort of the talking points I'm going to have are really around sort of cash flow, and obviously my expertise is foreign exchange, but it's worth taking yourself through the process and thinking, what are the knock-on effects to those delays elsewhere in my business? And obviously the first point is contracts. Now, we look at them as forward foreign exchange contracts and options, and some of the impacts that delays in your supply chain are going to have on the cash flow within those. But also it's worth dusting off the contracts that you've got with suppliers and clients. If you're anything like me, you won't have read the terms and conditions too detailed. But you know, suffice to say that they're normally stacked in the favour of the financial institution or the person writing the contract. So it's worth referring back to them. And from a foreign exchange perspective, looking at the flexibility, because if we looked at a foreign exchange contract and thought that is going to mature and deliver on a specific date, and because of the delays you've got, the cash isn't going to be required or isn't going to be available to settle that, you've got a few negative outcomes. One, that you could be sat on a load of currency that you can't use as working capital. Another, that you don't need the contract for another few months, need to close it out, and are therefore potentially facing a loss. Or that you need to extend it, and therefore that extension is going to eat into some of this working capital that you've got. Now, you know, we're probably all in a position that working capital isn't as abundant as it was back in February because of the added costs and burdens that we've had. And it's something that you really need to consider. Now, banks and brokers will write flexible contracts, and they can also make fixed and rigid contracts flexible. But I guess the adage is, if you don't ask, you don't get. And it's better to ask these questions ahead of the time rather than getting to the second week in January, realizing there's chaos at the ports, working out that you've got a contract for €1 million due and you haven't got the cash to settle it. So getting ahead of the curve in this instance, we think is the most valuable approach that you can take, and just have the questions. Now, sort of putting my sales hat on for a moment, I would say that, you know, if banks or brokers aren't playing ball with flexibility, then perhaps another broker or counterparty, Hamilton Court, can look at some flexibility and can help you there as well. So just because one person isn't willing to give you what you need or may require, someone else probably can. So it's worth exploring. The other point on the list around contracts specifically is collateral. Now, again, this points back to cash flow and cash being king and cash preservation being the name of the game, even to the detriment of profit, just whilst we're in these extenuating circumstances. But if you've got a load of contracts, forwards, options out, and the market moves significantly, like we saw back in March and April with the sort of the pandemic response in the markets, chances are you're going to get margin called. And that means that you're going to have to pay a load of money from your bank account into your counterparty's bank account. So the questions you need to ask yourself and understand are, at what point do those margin calls get triggered? So you know what to look for in the market. You know, telling someone that they get triggered when they're 5% or 10% out of the money is fairly meaningless. Whereas if you heard that actually, if sterling euro went to 120, you'd be margin called for X thousands of pounds. It's probably a much more valuable tool for you to have to be able to work out what your cash flow is like, and frankly, whether you can afford the calls. And if you can't afford the calls, or it's looking like that's going to leave you incredibly short to the point of discomfort, then we can we can do things around that. Again, the market isn't binary. Just because you've got a contract in place and a margin call at this level doesn't mean that you can't go back and renegotiate credit terms, collateral terms, or even put some limiting factors in there to stop you having this potential black hole that you're staring at, just throwing money into, that's sitting in a counterparty's bank account rather than your own. So I think that's, again, I don't want to sort of underplay or overemphasize this. It is a balancing act, but we saw it back in March with people that had almost been blindsided by such big moves and really didn't know where they were. And we've got an opportunity to get ahead of this now. And it's a phone call and it's a calculation for your counterparty. And at least then you're armed with the numbers that you need. I guess I think I'm flying through this as well, which is probably a good thing for you guys, not so much for me, because I might start to fill it in with some random comments. But as I've just done, brilliant. To hedge or not to hedge? So this is a question that we've been asked of clients for probably the last 4 years, given that we thought Brexit was going to be solved 2 years ago, then a year ago, and lo and behold, we're not there. And I think 2021 structurally is going to look very different to where we're sat now, or hopefully it is, because I can't do another year of Brexit uncertainty. But ultimately, we're going to get through this. It's going to be a few weeks of pain. Michael Gover's told us that it's only going to be 3 weeks of border disruption, which doesn't seem particularly helpful. And clearly, he's never worked in a just-in-time supply chain. But once we get over this hurdle, 2021 structurally is very different. There's a lot of money in the system. There's a new president potentially in the White House, though Trump's still not sure on that one. And the emphasis will be on trying to rebuild. So with that in mind, the answer to the question in our mind is, if you're hedging at the moment, continue to do so, but start looking more carefully at the forecasts that you've got, because if you're forecasting off of 2020 numbers, chances are they're going to be wrong or irrelevant for 2021. And the other point to say is, if you're not hedging and the levels that you've been used to for so long, sterling euro's been in a very tight range. Sterling dollar has moved realistically only about sort of 10 or 12 cents over the last few years. If you're used to these levels and comfortable at these levels, then really do consider putting in some cover to carry you through into 2021. Because if your hard work and all of your business development is undone by an unfavorable currency move, that would really be a sort of a painful and bitter pill to swallow. I've got the last point there, I'll make it the penultimate point, is what are your competitors doing? Because competition can be friendly, it can be less friendly, but they are a source of knowledge. And we've certainly had some conversations to establish what changes our competitors are making to their businesses in order to cope with this. And we've learned a lot, and sharing a bit of information is no bad thing. And if you can get back more than you give, then maybe all the better. But it's definitely a conversation worth having. The last point, actually, and I've spent the last God knows how many years sort of slating the government in the morning report, so apologies for that, Boris, but you deserved it. Is the government website is actually getting better and better in terms of how to prepare for Brexit. Now, obviously, they haven't got all of the answers themselves, and each time you go on, you have to refill in the survey, which can be a bit tedious. But over the last few months, as we've been checking it, slowly the answers have been padded out, and as you can tick things off the checklist, so something else will come up. So it is worth revisiting that, and sort of keep going through that as we roll on. But it is probably going to come down to the 11th hour if there's no deal all the way. So I guess the challenge we've got is that staff have worked incredibly hard over the last 7 or 8 months. Really looking forward to taking some well-earned rest at Christmas and hopefully being able to see their families. And that could be just the time that we need them in the office to do the paperwork and to sort of help us through the chaos and the frenzy that will be the rush to understand what the final Brexit outcome is like. So I'm not saying that holidays are cancelled, but it'll definitely be a firm negotiation as to just how many days you can get. I think that's worth considering for your own businesses, as much as you probably don't want to hear that. But I did promise to bring the mood down, and I think I've probably achieved that. So what I'll do now is I'll hand over to Ian and let him go through what he's got for you.
Thanks, Mark. I think in all the time that I've been doing insurance, nobody's ever passed me over the virtual mic and said that I'm going to bring up the mood, so I'll take that as a win. There's probably a fair few of you who don't know who I am on the call, so I'll start with doing a little introduction. So I'm Ian Leslie. As Mark said, I work for AON Credit Solutions, obviously based in the UK. Oddly, my background isn't insurance. My background is accountancy. I spent majority of my life from T-boy to finance director in accounts, SEMA qualified, and then I made the move 3 years ago now to go from the fast-paced world of accountancy into the even faster-paced world of insurance. So yes, that's me. So in terms of following on from Mark's themes, really, I'm going to do a little bit of scene setting, as hopefully you can see my slide as well. So whoever's idea this was to do the background, I think it's definitely a good one. So I'm going to do a bit of scene setting before going into, I guess, some of our tips around risk mitigation. So as Mark said, Brexit has been on the cards for quite a while, but obviously the last 12 months has changed quite a lot. For a start, the pandemic meant that Brexit became second place, arguably, and sometimes even further down than that, which was nice because at least we didn't have to hear about Brexit every day on the news. Obviously, it got replaced by something worse, but we win. But the downside of that is that a lot of companies, whilst they were prepared for Brexit, for obvious reasons, over the last 12 months, they've been fighting a much bigger fire, and therefore it has taken a back seat. So there is going to be an effect because of that. The other side is, regardless to which side of the fence you sat on, whether you were a Remainer or a Leaver, any estimations you made for gains or losses by us deciding to leave the EU wouldn't have taken into account a global recession, which is obviously what we're in. And I guess the level of that is still yet to be seen, given the amount of stimuluses that are in place. But what that does mean is that whilst it breeds new challenges, it does breed new opportunities as well. And I'll kind of come on to those in a little bit. The first point I've got on here is around economic bounce back versus business growth aspirations. And this really is, I guess, me trying to highlight the fact that we have a situation where the two are out of kilter. Arguably, that's always the case because businesses always want to grow regardless of the economic climate they're in. But at the moment, it's more exacerbated than it has been in years gone by. So if we look at 2020 as being the year of survival for businesses, just trying to make sure that you can get through this, doing adjusting yourselves as a business as needed over the last 12 months. 2021 is really a year where businesses will be looking to grow, to bounce back, and to, in some cases, reclaim some of that revenue that's been affected, over the pandemic period. You then got the government stimulus, as I mentioned before. I did an article back pre-pandemic about zombie companies. Excuse me. And the fact they're on the rise, and the risks that posed, obviously the markets in general. What's happened to zombie companies over the last 12 months is they've been given almost like a new lease of life because the government stimuluses that have been put in place, and rightly so, have essentially enabled them to continue to survive regardless to levels of trade, in most cases. So whilst there is this fear, and the fear is still there and still very real, that there's going to be an insolvency cliff edge in terms of businesses, we haven't really seen that. And in terms of claims in the market at the moment, there are still very low levels of claims. A lot of protracted default because of, because of where we are, but not as many insolvencies as what the insurers and what economists were predicting for kind of Q4 last year Q4 last year all the way through 2020, and obviously now looking into 2021. The other point here is around financials in 2021. As I've been saying throughout this, most people's accounts are going to look very different to what they look like 24 months ago. So I guess the question is, are they worth the paper they're going to be written on if you're trying to use them to assess a business in terms of risk? Obviously, they're still very much needed for what they're there for, but if you're trying to assess risk, it becomes a much more difficult playing field. Revenues have been affected, which means that year-on-year growth won't look right. People's cash flows will look odd. It's going to be a very difficult time to be an underwriter. But if you're looking on a business level, it's going to be a difficult time to be in a credit management team, trying to assess whether or not they should be giving payment terms to a customer. Add in then some of the other elements that Mark was talking about. So obviously in terms of from an FX perspective, but also the other margin squeezes we're going to see. So whether or not that ends up being tariffs, whether or not that ends up being because of the French border test, as Mark called it, and that ends up adding additional costs in terms of storage or depending on the business and the sector you're in, there is going to be additional costs. Add all of that in, as well as increased competition and changed consumer habits, which we've seen over the last 12 months, which even with a vaccine, there's no guarantee that people are going to go back to purchasing how they purchased before. It means that you've got this kind of powder keg of opportunity and risk in 2021, and a kind of treacherous arena that really does favor the brave, but it comes with its cautions. So in terms of what I wanted to put forward as a tip, it's really a solution that has been around for a long time. But unfortunately, because of what it does, it tends to be seen as quite a negative tool. But in this environment, I believe it's something that can be used to be quite positive. Obviously, I'm talking about credit insurance when I say that. And the reason why I think that solution is of aid in 2021 is because with that opportunity out there and with businesses looking to grow, it's going to be about taking smart, calculated risk in 2021. It's going to be about knowing your customers. And that is them pre-pandemic, but it's also the new them as well. So understanding how they've been affected and where they've been affected, and when they start to recover, how are they recovering? Because again, as the stimuluses end, it's going to affect many people on this call, but it's also going to affect your supply chains, and you need to obviously be aware of that as that changes across the course of 2021. And also the other aspect when it comes to customers, especially in the supply chain, is how your relationship with them is one relationship they'll have. And depending on the size of businesses on this call, you may be higher up or lower down their chain. So you may not be seeing any payment issues whilst other people are. And being aware of that and knowing that is key. It's also being aware of the market that you're in, but also looking at new markets and using, and maybe this is why Mark thought I was going to be a bit more upbeat, but using Brexit or maybe even the current climate as a starting point to look at new markets, whether that's in the UK, but also new markets across the globe as well. So this really is about making sure you have the information to make those informed decisions, taking the opportunity when it's there, but also making sure you're mitigating that risk as much as you can. And for me, that's where that whole bad debt protection credit insurance line, that's fine. And yes, okay, that is what it's there to do. And at the end of the day, if you have a claim, you're going to be glad you've got it. But the whole purpose of using that information, the whole purpose of the information that it gives you is that foresight to avoid that in the first place. And for me, that's why it's more of an opportunity enabler than it is a bad debt protector. The information it provides, in addition to the protection, can help give you that edge in this climate and an edge over your competition as well, which every little helps, right? Now, you're going to be starting thinking, yeah, of course you're going to say this because you work for AON and Credit Solutions, so it's an obvious sell, which, I'm not going to lie, obviously it is what I do. But the reason I wanted to be on this call isn't to particularly sell AON or credit insurance to you. It's because I truly believe that in 2021, it's going to be about taking opportunities when they're there. And to do that, and the best way of doing it is to mitigate the risk on the other side of an opportunity. And information helps with that. And if all else fails, the protection is also a good place to fall back as well. And I've seen, we have many clients across the UK, all sizes, shapes, the whole lot, from micro SME all the way up to billion turnovers. And the clients that use credit insurance properly understand that it's there as a tool to help grow, not as a tool to use in the event of a claim. And that's really the point that I really wanted to get across. A couple of other little bits before I pass back to Mark. Oh, I'm conscious of time. One is around credit forums. So again, there may be people on this call who already use them. It's worth looking at the moment because we've got the ability, like you've done today, is going in on Zoom. There are many out there. There's a company called Let's Talk Credit that does some, but there's others as well. They're worth their weight in gold. In this time when we can't socialize like we used to, it's good to just hear what other people in the market are doing, what problems they're seeing, just if anything, just to give you a red flag in advance. And the final point from me is around going back to Mark's thing on the .gov website. The government recently released some changes to duty deferment and the collateral that you have to post to do with it. So anybody who's got an account knows that you'll have to post collateral, which will still be the case for some, but they have a test that they're going to be going through. And if you meet certain criteria, then you won't be required to post collateral going forward. How long that will last for, it doesn't say. What the criteria is, last time I checked, it didn't say, but it is something worth looking at. And if either importing or exporting is something that you're looking to do more of, then obviously that could be quite an important factor going into 2021. So in summary, for me, I think whilst this year has been difficult for a lot of reasons, and whilst Brexit obviously isn't everybody's cup of tea, and I'm certainly not a Brexit expert, but I do believe that 2021 is going to be about growth. It's going to be about bouncing back. And to do that, I think it's about making informed decisions. And any way you can get that information, that's got to be a benefit.
Great stuff. Thanks for that, Ian. And I think to the point on the duty deferment, I was on a Zoom call with a client yesterday, and they actually had the application document next to them, and it was more akin to War and Peace than it was a simple form. So if you're going to go down that route, be prepared to sit there for an hour or maybe a day to get through it. But obviously it's well worth it. I think to the wider point as well that you made, more eloquently than I did, it's a recalibration of risk, because if you're going to take an opportunity, you want to best endeavors, make sure it doesn't backfire on you. And obviously your proposition there, Ian, is a great way of being able to do that. From an FX perspective as well. I think this particular snapshot in time and maybe into 2021 isn't necessarily about optimizing your profitability. It's about bulletproofing the business as best as you can. That will come at a cost to the top and to the bottom line. But if you've got that customer there and you become comfortable with that relationship at a lower margin, then hopefully into the future, later into 2021 and beyond, the margin can sort itself out, and you'll be in a stronger position as a business just because your numbers are that much larger. So again, sticking almost perfectly to time there, what we'll do if we can, and I'm not too sure on how to do this, I'll try and unmute everyone if there are any questions, but we'll sort of wrap it up there. I'll also share Ian's details to the attendees, so you can pick up with either him or myself offline if you don't fancy asking any questions now, but we will be around for a while. I've just got to work out how to unmute, and I think it's that one there. Lovely. This is where it could all go wrong. So if anyone's got any questions, do feel free to shout them out. But if not, thanks for attending, and feel free to exit through the gift shop, as it were.
Hi, I've got a question for you, Mark.
Hi.
How do you see exchange rates changing then as a result of all this in January?
I mean, we're still on the proviso that we do eventually get a deal. If it goes down to the 11th hour, then the markets are going to wait until the last minute to sell sterling. Then they'll sell it hard if there's no deal. So the pound would be significantly weaker come January the 1st. And then hopefully Whitehall sees sense and we start to cobble together some arrangements that don't lead to gridlock, and progressively we pick up. I think if there is a deal, we've spent the last 4 years watching money leave the UK, as our position as a gateway to Europe is less pronounced. And it's going to take time for the real money to flow back in. So the pound will appreciate, but I don't think it's the hockey stick or the U shape or the V shape recovery that it could be, because again, our position is fundamentally different in the eyes of the world in what being in the UK brings you to the rest of Europe, if that helps.
Yeah, great, thank you.
Great stuff.
I've got a question for Ian, if that's possible.
Yep, just take myself off mute.
Hi, Ian. It's actually talking to a client the other day, and just the difficulties that they were facing in terms of getting credit insurance on behalf of some of their suppliers. Is there a way, obviously you talked about, the products that are available and the solutions, etc. Is there a way of rather than obviously going through the hassle of making an application and paying, whatever that cost may be, if they can get the cover in place, is there a way of getting any kind of discount-free trial, etc., to actually get access to this kind of information? Or sort of, I guess nothing in life is for free, but is there a way of somebody making a decision or trying to get some more information before they go and try and go through the rigmarole of actually getting a policy in place?
Yeah, it's a good question. So the short answer is yes. There is. There are policies out there which are called limit-only policies, and that is where you essentially pay for the information on your customer base, and you apply for those like you would do a limit if you had a policy. But importantly, you don't have any policy there, so there is no risk mitigation as such, which means that the insurer hasn't got there's no risk on their balance sheet either. So it's obviously considerably cheaper than buying the premium. It's not free, and there isn't kind of any trial periods for anything, but it's something you can look at. So if at the moment, for example, because when we're looking at a policy, we always look at what we call the credit limit acceptance, which is basically what percentage of your customer base or your sales ledger is going to be covered. Back in the good old times, that would have been, you'd have aimed for around 75, 85%. It was pretty good. Depending on what sector you're in today, you probably find that's much less than that. You could be sub 50%. So insuring as a risk mitigation tool at the moment might not be what you want to do. But as you rightly said, Ben, you could use it as a limit only and therefore get access to the information. So you can still use it as a risk mitigation tool in terms of yourself and using that information to either trade more or trade less with a customer. You just you can't claim, obviously, in the event of a loss. So there are options available. There's a couple of insurers that do it, and you obviously can still use a broker to go through that. And again, from the information side, I always recommend a broker. And again, people think, of course, you would, but I would, because obviously we have access to lots and lots of other areas of information, all of which you don't pay for. So, yeah, yes is the short answer to that, Ben.
Thank you. Cheers, Ian.
All right.
Great stuff. Are there any more questions out there, or should we wrap this one up? No.
I was going to ask you a question, Mark, but am I allowed to ask two questions?
You could ask two, Ben. You can ask three if you need to.
It's just in terms of contract terms. You mentioned earlier on in your conversation about sort of trying to get additional information from your current providers. Are the contracts flexible? Can they be changed, etc.? Mm-hmm. How easy is that? In terms of a client that might deal with a bank and multiple brokers or a couple of banks, etc. How easy is that information available to themselves?
I guess, like, similar to Ian's, the brokers will be more responsive and be able to get it to you quicker. The bank will probably depend on the level of competence you've got and probably how high into the bank you go when you're looking to get any information from them. in reality, it's a 10 or 15-minute exercise for anyone that you're making the request from. So it shouldn't be too arduous, but just bear in mind, the usual excuses of working from home, offshoring, admin work and these things will take a little bit of time. So I'd say get the question in first and early, and let them come back to you. If you can't do that, then it's a simple calculation for us. So if you've got a list of positions, we can tell you, exactly what their mark to market value is, and at what point you'd get called for margin. So it's something that someone else can do, but you've got a counterparty relationship, and they should be forthcoming with the information that you want.
Okay, thank you.
Great stuff. Okay. Well,
Mark, I got one.
Go for it.
So what would your advice be to companies that are tossing up the dilemma between being comfortable at taking out cover at these levels, as in say the 110 mark, and they are buyers of sterling, but have the dilemma of, due to COVID, unsure about their forecasting for next year?
Depends on the size of the business, and I'll caveat this by saying, that to certain size organizations, you could look at options products by where you can hedge 100% of your forecast, but only be obligated for a smaller percentage of that. That'll come at a small cost versus, from the overall exchange rate that you'd get recover at. But I think, as Ian said, you need to look at your own business as to what 2021 will look like for you, and go in prudently with it. The recovery is going to be uneven, but it's also going to change a lot of habits and a lot of consumer trends. So there's no point looking at 2021. It was an anomaly. There's little point in looking at 2020. It was before COVID era, and things will change. So definitely tread carefully. Don't be too bullish. And again, comes back to that, give up some profitability to get some security around what you're doing and some comfort, and take the risk out of it. And that's the way I'd approach it, if that makes any sense.
Yeah, just
lovely. Okay. Last call, going once, going twice. No, well, thanks everyone. I'll click the end meeting now, and I'll send around the link, and also Ian's details, so you can watch at your leisure. Thanks all again, and best of luck over the coming weeks. If we can be of any help to you, please don't hesitate to pick up the phone. It'd be good to speak, and if we can go on a Zoom again, and maybe I'll wear a shirt for more than the one occasion this year. So yeah, look forward to speaking to you and seeing you in due course. Thanks a lot. Bye bye.